The agony of financial foolishness speaks to us from the yellowed pages of history, but it couldn't possibly happen to us. They were idiots. They were fools to pursue such clearly doomed policy. In retrospect, every disastrous episode of hyperinflation appears absurd, humans reduced to silly and impractical behaviors, an illusion of comedy that conceals the suffering beneath. But we are not like them, these sad ghosts from the past. We have amazing technology and have progressed far beyond our forefathers' crude ignorance. We could never fall into such a blatantly obvious trap as trying to print our way out of debt. The arrogance, the sheer audacity, that is them, not us, isn't it? Everyone knows the general story of Weimar Germany, but it's worth going over the details again. To pay for the First World War, Germany incurred a large amount of gold-denominated debt. In order to pay these debts, Germany suspended the gold standard and began printing money. In this manner, the German government removed purchasing power from its citizens and their savings, transferring that purchasing power to newly created paper currency to pay debts. Following the war's conclusion, Germany was saddled with even more debt as a result of war reparations imposed by the Treaty of Versailles in June 1919. A financial mountain. Germany was able to meet its obligations for a few years. However, by 1921 the debt payments had become too high. The government had run out of ground and had two options. 1. Shamefully default on their international debts, or 2. Print as much money as was required to purchase the foreign currency required to make debt payments. The bureaucrats naturally chose to kick the can as far down the road as possible. Over the next 2 years, everyone on the planet who owned German marks saw their purchasing power dwindle to zero. After catapulting Germany into the Dark Ages for 2 years, the country was destitute and ripe for populist extremism to gather up the wounded nationalist spirit and carry it into an even more terrible Second World War. However, for our purposes, the most notable feature of this classic hyperinflation story is a minor detail. Weimar hyperinflation was punctuated by sharp bouts of deflation. At first, the graph appears to be an upward curve pointing directly to the sky. However, if you look closely, you will notice brief dips along the way. These are short-term periods of deflation. Overlapping the monthly inflation rate on the same data confirms the story. Hyperinflation causes volatility, mostly to the upside, but occasionally to the downside. While it is not likely that the United States will go through the full Weimar experience, particularly because its obligations are denominated in US dollars, which can be printed rather than gold, which cannot, it is quite possible that the same mechanics will play out on a smaller scale. We've just entered the deflationary period of 1917. Money supply M2 contraction. Strange economic tides are roiling at the moment. For the first time in modern history, the US dollar M2 money supply is contracting significantly. For those who are unfamiliar, the money supply is typically measured in a variety of ways. The first level, M1, is the amount of actual dollars in circulation, which includes physical bills in your wallet, as well as the digital number displayed in your checking account. M1 plus savings accounts, money market funds, and other deposits comprise the second level, M2. For all intents and purposes, the M2 money supply is the widely accepted metric for determining the amount of money in circulation. How can M2 be shrinking if no one is burning stacks of dollars as firewood? Understanding the accounting mechanics of our credit-based economy is critical here. When a company obtains a $1 million loan from their bank, they log in to see the funds in their account. What happened to them? As part of the Federal Reserve banking network, the commercial bank created those dollars out of thin air. As a result, the bank created a $1 million deposit liability on their balance sheet, which was offset by a newly created $1 million loan asset, which will generate interest income for the bank over time. M2 increases when commercial banks make new loans, that is, create money, faster than existing loans are retired. When banks retire old loans faster than new loans are issued, M2 shrinks. Banks are currently slowing new lending to a trickle. This is primarily due to banks' risk management obligation to maintain a certain ratio of bank deposits to outstanding loans, a ratio that has recently been strained by the exodus of deposits to higher-yielding money market funds. It's happening for prudent reasons, but it's still unprecedented. The net result is that M2 is contracting due to credit contraction. And in our credit-based economy, where economic growth requires lending through credit expansion, the opposite trend is widely regarded as a warning sign of a coming recession. The United States debt ceiling. The other piece of the puzzle is the impending debt ceiling crisis. You may have noticed that an old song has returned to the news. Will they or will they not raise the US debt ceiling? Of course they'll raise the debt ceiling. The US is exceptionally good at saying yes to more debt, and neither party wants to draw a line in the sand. The true goal is to score political points by pretending to be concerned about the national debt before voting to increase borrowing anyway. The politician's creed is to spend now and leave the bill to your successor. The only unknown is how much political wrangling will occur before the US incurs additional debt. We're not off to a good start, unfortunately. In fact, the United States technically reached the debt ceiling on January 19th. Since then, the US Treasury has been forced to avoid default by employing extraordinary accounting measures, which would almost certainly be considered cooking the books if done by anyone else. While the debt ceiling political theatre dominated the news for several weeks in 2011 and again in 2013, there is good reason to be concerned that the two sides of the political aisle have grown increasingly unwilling to compromise. According to the US Treasury, lawmakers have until June 2023 to resolve their differences. After that, the extraordinary accounting measures that keep the lights on will be rendered ineffective. Will the politicians be able to reach an agreement? There is cause for concern, according to the market. Here is the most terrifying chart in finance right now. Notice the recent difference in yields between 1-month and 3-month duration US government debt. This has never happened before to this extent, and it should never happen again. Why is this happening? The market appears to prefer holding 1-month duration US government debt over 3-month duration debt. What's the reason? For the first time in modern history, the bond market fears that the United States could default on its debt within the next 3 months. In contrast, the bond market never believed there was a genuine risk of default in 2011 or 2013. Despite the fact that there is unlikely to be a serious risk of default, the narrative of fear and uncertainty surrounding the debt ceiling will almost certainly continue to escalate as politicians engage in their inevitable brinksmanship, knowing that they only have a few months before a deal must be reached. This could cause havoc in asset markets in the coming months. So, how will this affect the price of Bitcoin? The government will eventually do what they have to do, raise the debt ceiling. That means more money will be printed to fund the newly authorized deficit spending. The eventual approval of more debt could also coincide with the need to combat the deflationary forces that are now taking hold through credit contraction, which is on track to send the economy into recession. And if that occurs, the Fed will do what it does best: inject additional stimulus. In other words, because of the debt ceiling crisis and the inevitable 1917 style deflationary period, the money printer will get hot. When that happens, asset prices will skyrocket, but none more so than Bitcoin. Look at what happened following the COVID pandemic era stimulus. So right now, Bitcoin is looking like a good bet. We hope you liked this video. If you want more, check out our other videos on the screen. Thank you for watching.